Aloha everyone, Joshua Hayes at BigWaveTrading.com. It's not often I'm completely wrong on my thesis on the market. Completely wrong. Have no problem admitting whenever I'm wrong trading wise. And I tell you what, the bounce that we saw yesterday, we should have followed through immediately and or pulled back on lighter volume with a short small price decline. Instead, you can see that the Russell 2000 reversed with a bearish engulfing candle on heavier volume. The NASDAQ 100 was a bloodbath on the reversal candle. The NASDAQ also very bearish engulfing candle. Dow Jones Industrial Average not quite as bad, but still that's a very, very, very ugly chart. And the S&P 500, the exact same thing. Not only was I wrong about this bounce of testing, don't get me wrong, you know that I knew that it's possible we could crash. I told you that a crash is very possible, but with the way that we bounced on Monday, following the way that my long positions held up, the stocks in my perfect speculator scan held up, it was not convincing, but it was hopeful that any bounce attempt could be a very good bounce attempt. And like I said yesterday, had we had stronger volume based on the way everything looked, I would say that we bottomed. But there were a few red flags like PTGX and BNSO crashing wide open along with CUE completely reversing. But today was about as bad as it gets on my end. I haven't been this wrong since Brexit. I really wish new positions wouldn't trigger the ones that have good enough reward risk ratios. All I've done this year has made Interactive Brokers extremely rich with my commission costs. I tell everybody if I didn't have a larger account size and or paid more in commissions, you would never see me take all of these signals if I really had to tighten things up. But, you know, I took them because the vast majority worked until today. Today was the first time since Brexit that the vast majority of the stocks that I took did not work. And not only that, I have a current max paying dollar amount that's half of what the normal size is. 3 stocks hit it. ANAB, which is a 100% sell signal, immediate reversal. Sky, immediate reversal. ATRA, immediate reversal. Were the patterns great the previous session? No, but I told you with Sky, that's a pattern that in a different kind of market I really like, and I love it, especially if it has max greenbot. But you see how it performed today? That's about as big as a red flag as you can get. So for the first time since Brexit, the vast majority of the long signals the very next day immediately failed. And they didn't just fail, they failed spectacularly. I also have my largest account drawdown since Brexit, and it also was the first time in 2018 that my account loss is larger than an index loss, which I believe was the NASDAQ 100 down 3.32%. I was down 3.5% today. And it's the first time for long. And not only that, intraday, I was looking to play the SPY calls on dips, not looking to sell the SPY puts on rips. I thought that we definitely had more to bounce. So everything about today's session is bad, and it doesn't get any more bad. So the game plan here, as you can see on the new positions page, there's a lot of 50 and 100% sell signals. If you see your stock on that list, you move half or 100% of whatever you're long to today's low a day, 1 cent below today's low a day. New long positions are on complete hold. There were only a few that flagged. Like, for instance, I'm watching NCNA to hopefully round out in base. CCT triggered, but it's not a cancel. I'm a perfect speculator stock. It's extended from its 20-day moving average. No way. Not in this tape. Then you had NWY, a perfect speculator stock. That's an earnings winner. Closed too far off its high of the day. No way. Even with that volume surge and bot move. No way. Not happening. And then there was my favorite setup currently out there, PetQ, Pet IQ Incorporated. You can see it's consolidating since its earnings win. I was interested in getting long this day, but it managed to back off. Then I was interested this day, but it was up too much. Now it's consolidating. I'm interested again, but it closed below where it opened. So it cannot be a new long position under my new tightened requirements. INPX is the only other one I flagged, and it did more work in the bottom part than the top part. What do I mean by that? From the open to the low of the day, there's only 3 cents. From the high of the day to the close, there's a 4-cent gap. There's a bigger gap on the upside than the downside, so no way in hell can INPX be a new long position. But, you know, compare all that compared to like some of the sell signals. Let's look at the 100% sell signals. ADVM. Now, remember, on all these that I show, if you're still long, you move your final stop to 1 cent below today's low of day. But ADVM, FTNW, CVEO, NEPT, FTFT, which is a speculative name, but still it's a full sell signal, VCO, ULH, RELV, Twitter. You can see the same thing in all of these. They're all not only failing, but they're doing it as a rollover fail. They're rolling over like they just climbed up the top of the hill. Now they're rolling down the hill, and they're rolling over, and they're doing it on heavy volume. So my inclination is that this could get a lot worse. Now, what's interesting is that what I just showed you was all of the full sell signals. On an end-of-day basis, I'm still tracking 200 stocks, either that I'm long or tracking for the website. That means I'm still tracking 200 stocks that since my long entry is still either in an uptrend or has not closed below my final recommended final sell stop level. So that's kind of crazy here with the way that the market's looking. With the market looking the way it does, I would expect that I'm only tracking or long maybe 100 names, definitely less than 100 names, but 200? Nah. However, if the market follows through on its selling on either Wednesday, Thursday, or Friday, and especially if the NASDAQ takes out that February low, the Russell 2000 takes out these February and March lows, and the S&P 500 cracks below that 200-day moving average in February low, it's going to turn into an all-out bloodbath. And what makes today even worse on my end is that at the opening bell, I was knocked out of a third of my SOX S, a third of my SQQ, and some other hedges right before the market reverse. So when it comes to a bad day, this is about as bad as it gets on my end on an end-of-day basis. That being said, none of this was not expected. This was always in the back of the mind that this bounce could fail, roll over, and I would be screwed with my long positions. Not screwed yet, but if there's any more selling, I'm screwed. But the good news is that I know how to protect my capital. I know how to protect my gains. I raise my stops higher. I get the hell out if anything does start acting bad. And instead of crying over spilt milk and running away and never looking at the market again, I just wait for the next round of great end-of-day signals with a better market environment. If one thing is proven to me, it's that even in the uptrend, this entire time in 2017, new long signals, they just don't produce the gains that they used to before 2008. Everything has changed now that algorithms and computers are in control. But one of the things that hasn't changed is that the market's personalities is very similar to the way it's always been. This market is acting like it did in 2008, and by that I don't mean it's going to be like 2008, but there's volatile markets and then there's extremely volatile markets. There's orderly volatile markets and then there's random volatile markets. This is a very random volatile market, very extreme price moves after basically pump and dump price action for an entire year. These are how pump and dump charts fail, break down, roll over, and crash. And our indexes actually look like pump and dump charts, which is what's hilarious because I quite have never seen anything like this. These ETFs did not exist back in 2000 to 2002, so I can't really compare them to that time period. And a lot of the leverage ones didn't exist in 2008, but like with some of these things, I mean, this looks worse than 2008 top did, but we'll see. Anything can happen. You know, there's a lot of bearish sentiment starting to drive up, but you know, I can't stress this enough. You got to protect yourself here. If you're not trading intraday, those SPY options, man, they move 100% plus every day. Every day these things move 100% plus intraday. If you can game them versus the doji reversals, head and shoulders, along with the 10 and 20 day exponential moving average cross, there is some large gains to be made that you just can't get on an end of day basis, and we probably won't until the market calms down and finds a floor. So until that happens, I'm flipping the switch. I'm no longer interested in new long positions. It's all about protecting capital. For anything to be a new long position, it has to be perfect. Everything has to line up. It can't be extended, has to close near the high of the day, has to be the reward risk ratio has to be at least 5 to 1, and the inherent risk must be under 5% right now. And if it's not, then I have to move the capital accordingly. But right now it's all about safety. I do have one trade I'm taking on an end of day basis, and that's a position short China, the ultra short China 25 ETF. I'm going to get long 2% of my account capital using a limit order at 1561. I will have 4 stops: 1488, 1416, 1380, and then 1236 initially. But my God, am I ever on the wrong side of this market. Not because I didn't know it was happening, but because the signals kept happening. And this just goes to prove that the computers have just taken complete control of end of day signals, and that you just cannot trust them unless the market is moving higher. Now, like I said, we reverse higher here. All the signals I'm still long, I'm holding, and I'm sitting pretty if we bounce. I just don't think that's going to happen. So protect, protect, protect. Raise those stops.